Well, hello, everyone. My name is Brian Ballentine, one of the podcast members here at Connected by Community, brought to you by Ballentine Capital Advisors. I just want to take a moment and thank everyone for listening, sharing, liking our podcast, and allowing us to share with you more about our community. And I want to take a special moment to thank our sponsors for allowing us to partner with them and continue to bring you these nonprofits, community interest, business leaders in our community and what they're doing for and in our community. I'd ask you to check them out. They allow us to continue to bring this to you. And if you or someone you know would like to know more about becoming one of those partners with us, check out our website, connectedbycommunity.org. There you'll find a sponsorship tab, and we can get you more information on that. Until we see you next time, go out and make our community great.
Hello, everyone. Welcome to another episode of Connected by Community, brought to you by Ballentine Capital Advisors. I'm one of your hosts, Anthony Colancecco, and with me is the one and only Cameron Cannon. And today we're going to talk to you all about taxes. I know it's tax season, and it's a fun topic. But before we jump into taxes, I figured Cameron and I could tell a little bit about us for our new listeners out there. I'm Anthony Colancecco, Wealth Advisor and the Chief Operating Officer at Ballentine Capital Advisors. I've been with the firm for about 4 years, but been in the industry for about 15. I have a wonderful wife, Jacqueline, and two wonderful daughters, Vienna and Selena.
Yeah, awesome. Yeah, well, thanks so much for having me today. Excited to be here again. We're in this awesome new studio, so super excited to be here. Yeah, Wealth Advisor as well, Cameron Cannon at Ballentine Capital Advisors. Been there for almost 2 years now, been in the industry since I got out of college, went to Clemson University, and just been learning the ropes ever since, and passed the CFP exam back last March. So just been excited to jump into the whole financial planning process, and excited to talk about taxes today. I think one of the big things that people miss, whether they're working with just an investment guy or maybe kind of doing it on their own, especially when you get close to retirement, is the tax planning in general. Retirees, there's a lot of tax things you got to look out for, and especially high income earners as well. They might be paying a little too much for taxes and maybe not reviewing their tax returns like they should. So I think that's one thing that we do that's a good bit different than a lot of the firms in the area, is really honing in on tax planning and not paying Uncle Sam too much and giving away unnecessary dollars. So excited to talk more about that today. Yeah,
and so for everyone, the tax deadline is April 15th, April 18th, unless you filed for an extension. But one thing we're going to talk about is the difference between tax planning and tax preparation. And I'm going to let Cameron jump into that.
Yeah, so it's one of the funniest things that happens in our in our line of business is a lot of times folks come in and they're either frustrated about how much they paid in taxes, or maybe the one thing I hear a lot is, oh, well, my CPA should have done this right. And one of the things I always like to point out is tax prep. You're looking at what happened last year, and unfortunately, unless everybody has a magic pill that I don't know about, you can't change the past. But you can change the future and plan for the future. So tax prep is looking at what happened last year and making the most out of it. And tax planning is looking into the future to say, okay, what is my tax situation going to look like going forward? What are some ways I can minimize it? And what are some things that I can do and some strategies that I can use going forward to hopefully make the most of the money that I'm earning and keep the most of it. So I think that's one thing that a lot of people get confused is tax prep versus tax planning. And I think that's one of the things that we want to look at, right? There's no good financial plan without taking into consideration taxes. So one of the things that we always look at is we want to review, especially for new clients and existing clients, a tax return every year. Obviously, throughout the year, we're going forward and kind of looking at, hey, what's your situation? What might change? If you're coming up to retirement, maybe you did retire. Are you turning on Social Security? Are you on Medicare yet? Are you on ACA? There's a lot of things that taxes affect and that your income kind of has an effect on. So I think one of the things that you want to look at is reviewing somebody's tax return, especially a new client that comes on. We often find a lot of maybe not mistakes, but some things that could have taken better advantage of. And I'll give an example. So a lot of folks that are retired, they give to charities, their church, et cetera. And unless you're, itemizing, you're not getting a super fantastic deduction when it comes to charities. They cap that out. So one of the things that we look at if you're over the age of 70 and a half is something called a QCD, which is a qualified charitable distribution. And it's one of those things that you can give directly from your IRA, which is typically pre-tax money, directly to a church or a 501c3 nonprofit. and you get basically it's tax-free gift. So, it's better than taxes because you're not paying any tax on it. So it's better than a deduction. So that's something that we see a lot. I was reviewing a client's tax return that, last October and noticed that they had given, almost $10,000 to charities over the year, but they were still using the standard deduction because they didn't have, mortgage interest and et cetera to write off. And one of the things I asked them is, hey, is this a one-time thing? Are you going to continue to do it? And it's something that, they just give to the church every month. So I said, hey, what if we just give this directly from your IRA to the charity of your choice or church? And instead, you're not paying any taxes on it. And then on top of that, it also counts for your RMD for the year if you're not using it. So for a lot of folks and a lot of clients that we work with that, maybe they don't need their RMD money, they have enough guaranteed income. It's something that you can do and not pay unnecessary taxes on. So that's one cool strategy that we've seen, especially through reviewing tax returns.
Now, I will just state we're not CPAs, but we do work closely with CPAs. Could you explain that relationship?
Yeah, I think one of the most important things that we do is working with other professionals in the industry. So estate planning attorneys, CPAs, for example. Everybody has their role. So I kind of like to think of us as the financial quarterback, kind of looking and making sure that everybody's talking to one another. So, the best relationship that we could ask for is to have a client that works with us on an ongoing basis. We're looking at the investment side, the planning side, the tax side, but then we're bringing in the professionals on the back end who really know your situation in and out and are experts in that field. So we work with a lot of great CPAs, some specific ones in Greenville that we've had fantastic relationships with. And I think that's where you find the best, combo is when your financial planner is also working with your tax expert, is also working with, your estate planning attorney to make sure that every side is talking. So that way, we're doing the strategies on the front end, running it by them, like you said, because we're not CPAs, to make sure that it's compliant and it makes sense. And then on the back end, they're not missing things because unfortunately, the IRS still doesn't have a form or a box really to check if you do QCDs, for example. And one of the things that people often miss is they don't tell their CPA or their tax expert, hey, I did a QCD, and then on their 1099, it looks like they just did a distribution. So now you gave them money to the church and you didn't get a tax deduction for it. So it kind of just, negates what we did. So that's something that we oftentimes have to fix. And if you're working a hand-in-hand relationship with a CPA, it's just a little bit smoother of a transition and things often don't get missed as much.
Now, one important things that you said earlier was planning, right? Having a plan and going by a plan. I think there's a big difference between BCA and a lot of maybe just investment advisors that are out there that are handling investments but aren't doing the full planning. Do you have anything you might want to add to that?
Yeah, it's frustrating to see when clients come in and, maybe they're working with a big box shop that is just, maybe they're quote unquote doing a plan, but they're just plugging in numbers and, meeting once a year to talk about the investment performance. And planning goes a lot deeper than just investments, as you know. I'll give another example, working with clients that are close to retirement and maybe they haven't turned Social Security on yet. Maybe they have guaranteed money through a pension, but maybe they're not on Medicare yet. And one of the things that you got to look at is, if you're on the ACA or Obamacare to get you to Medicare, how much you pay and premiums, and if you get a credit for that is based on your income levels. So it really, and taxes affect that, right? Because if you're taking money out of an IRA, it's taxable, et cetera. So taxes are all about what levers you can pull, and so is financial planning because, if you're just looking at investment performance and maybe not looking at the whole picture, you might be pulling a lever that has unnecessary consequences that you weren't really looking for. And that's something that we see a lot that people aren't maybe keen on looking at. They're just hooked on, what's my performance? What's my performance? Or, I have a plan, and we look at it and they're really missing a lot of factors, whether it's that or QCDs or RMD strategies, just on the tax planning side. That's something that I think gets missed a lot. And I think that's something that's where the majority of the value lies in financial planning is really taking the whole picture, projecting into the future, but still every year things are going to change. One of the things that you mentioned earlier is, tax laws change, right? Contributions limits change. So you want to make sure that you're up to date on all of that to really take advantage of the opportunities that are out there.
That's a great point. So for contribution limits or for folks that are still working or contributing to an IRA or a 401k, those limits actually changed and they had went up. So now is the perfect time to sort of look at what you're contributing to see if you have to up your monthly or quarterly amount that you are contributing because those limits have gone up. So that's a great example of planning versus preparation.
Yeah, and I think you made a great point too. And one of the things is if you wait and you don't have an advisor or planner that's looking for that, well, now you're at the end of the year and you got a huge 401k contribution that you could have made. But I mean, you can't take $20,000 out of your paycheck at once for most folks. So it's something that you really got to look at the beginning of the year and really just keep up on everything. And if that's something that you're not looking for, you're probably going to miss opportunities. Another example is, Roth contributions. You can technically make a Roth contribution for 2022 up until the tax filing date. So for a lot of folks that are right on that phase out limit based on your income levels, you wait until the end of the year, see what happened, and you can make a retroactive contribution. And that's something that's huge because obviously if you made one in the previous year and then you ended up going over, you got to take the money out and et cetera. So that's something that we see a lot of folks, especially new clients that come on that are on that, on that bracket or, almost over the level. Well, let's see what happened last year and you can make a retroactive contribution, which is huge. And that just kind of goes to show that, you got to be looking into the future as well, but you can also, work with CPAs to kind of have an estimated tax and see what you can kind of do from there.
Yeah, it's perfect to start planning for that too, because in Roths there are modified adjusted gross limits, right? So you can't just contribute to a Roth. And I'll give a perfect example. We do have a client out there that contributes to a Roth monthly, but reviewing their tax documents and their W-2s in January and February, we realized they'd made too much. So now we have to recharacterize that and remove it because they made too much. So doing some of that planning and reviewing some of the taxes and the tax returns and W-2s as a firm is huge for our clients.
Yeah, and I mean, you made a great point. Like they could have been making a monthly contribution right on the limit, and then boom, it's December. The firm that they work at had a great year. They get a huge bonus. Well, now they're over the limit. Now you got to recharacterize those contributions. And if you don't, there's obviously penalties. And if that's something that your planner's not looking at, or you maybe aren't aware of, that could be a big issue. So, those are just small, examples of how it really is important. One of the things that I wanted to hit on too is, small business planning, right? You work with a lot of small business owners, whether they're, setting up 401ks, SEPs, or even defined benefit plans. I guess, can you talk on that, how important that is, maybe some of the tax savings that you can get? And even, we've met with plenty of recruiters, how important it is to offer those services to keep employees, happy and on board.
Yeah, it's really important. Come December and January, I think a lot of business owners start thinking about that, right? They start thinking about, all right, I now have 5 employees and I want to retain them. What are some of the tools that I have available to offer some of my employees? And one of them is a retirement plan, like a 401k or even like a SEP IRA. There's different rules for both. 401k will allow you to basically put out the maximum amount that you can and save in taxes as a business owner. But offering that gives employees the ability to start thinking about their retirement. And the government's really pushing that with the new Secure Act that sort of came out. They're now allowing employers to start taking that credit. So they are giving employers credits for taxes to start a 401k retirement plan. They're really trying to push folks to start helping people save for retirement, because the reality is Social Security, that we have our issues with Social Security,
Yeah.
right? So people not thinking about retirement and saving for retirement, they can get into a lot of trouble. Then business owners, maybe they're solo shops. There's different strategies that they could do if it's a SEP IRA or a solo 401k or a 401k with a cash balance plan, right? It's really just trying to figure out the business owner's goals and plans and what they're trying to do, but that will really help them save in taxes.
Yeah, and I think one of the things you mentioned too, which I think is, the writings on the wall is, I mean, for most folks that are, in their 40s, there's no more pensions at most places. So you're not going to have that guaranteed income. We got our own issues with Social Security that could potentially go defunct at some point. Who knows if that'll actually happen? But I mean, I don't personally plan on having it. I think there'll be either something else or it'll be means tested. So I think the government's kind of telling you in the most polite way, like, hey, it's kind of going to be up to you to be able to afford your retirement. So you need to make sure you're thinking about it now. And I think that's awesome that they're giving, business owners more credits to kind of incentivize them to do it as well, because I think they understand that, hey, we might have overpromised and we're going to underdeliver, and that's going to be a big issue. And one of the things that I think is always interesting, especially on the business owner side, is that they get confused on a deduction versus a tax credit. And I guess, can you just very simply explain the difference between a tax deduction and a tax credit and how they are not the same?
Yeah, I mean, the deduction, you're basically lowering your income up front, right? So if you make $100,000, you contribute to a 401k at $10,000, you're paying taxes on 90, right? So that's really the big difference, is you're lowering your taxes up front.
Yeah.
Your taxable income.
Yeah, and then a credit is obviously a credit of the taxes that you owe.
Yeah.
So one of the things that I think's almost hilarious is that people are new to, maybe don't understand, or maybe they're not working with a CPA. It's like, oh, I'm just going to go write off this new truck that I just bought, and it's going to be fantastic. I'm going to pay no taxes, and it's like, okay, sure, but you're still spending money. You got a deduction. It's not a tax credit. Huge difference.
Huge difference.
So people are like, oh, I'll just write off everything, no big deal. And it's like, okay, well, now you made no money. So it's more of an issue than that.
Yes.
So I think we see that a lot too, and it's just interesting to see.
So let's talk about some strategies. Obviously, there's strategies for folks that are working, and there's strategies for folks that might be, retired and taking distributions. So maybe let's talk about the difference. Folks that are working have, 401ks or IRAs and Roth accounts to help with saving on taxes. But let's talk about folks that are retired, that are taking withdrawals. What's some strategies? I know you mentioned a QCD. Is there any other strategies?
Yeah, so I mean, one of the things is, if you're still working and you're not taking distributions, you're in the accumulation phase, right? So it's the most important to figure out, hey, how can I most effectively save for my retirement? Whether you're doing 401k, maybe it's pre-tax, maybe you're doing post-tax or a Roth 401k, and how does that make the most sense? Are you able to fund a Roth IRA, traditional IRA, a non-qualified brokerage
or even
account?
a backdoor Roth?
Yeah, or a backdoor Roth. There's a lot of different strategies around that, but really it's about, hey, how can I most effectively save money for retirement? And make sure that you have some levers in retirement, right? Because one of the things is, a lot of folks like, oh, I got $1 million in a 401k, but it's all pre-tax. So you don't have $1 million because you're paying taxes on that money that's coming out. So I think that's something that there's a misunderstanding, versus if you have a Roth that comes out tax-free, as long as you meet the rules, obviously. So I think having those levers and really thinking ahead and strategizing is important. But for, like you mentioned, for retirees, you're already there, right? You're taking the money out. You need to have a paycheck. You really need to make sure that you have a strategy around how the money's coming out, not only on the investment side, but the tax side. So on the investment side, a lot of folks, what we see is they come in and they're just selling off of their whole portfolio and taking $3,000 a month to make up a number. And one of the issues with that is, okay, well, say you have another 2020 or 2022, the market's down. So now you're selling off while the market's down and you're taking money out. So what that's called is sequence of return risk. And it's a huge issue that not a lot of folks talk about. And one of the things that we do fantastic is the bucket strategy of retirement income, where every dollar has a purpose and you're planning for that, and not just investing, all of your eggs in one basket. So on that, I think that's huge. But on the tax side, yeah, how are you taking money out? If you're on Medicare, are you getting hit with IRMA charges, which is income-related monthly adjustment amount? How much you pay for Social Security Part B and then Part D for your drug plan? That's based on your income level. So if you're over a threshold, I think it's $194,000 for 2023. If you're married filing jointly, you're going to pay a surcharge on that. So maybe you had a Roth IRA and you could have taken a little bit of money out of that, or maybe you went $1 over because you took too much traditional IRA contributions and your adjusted gross income was too high. Well, now you're going to get hit with a penalty or a surcharge on that. So I think that's important to look at going forward. Is we see a lot of folks that are high income earners, even in retirement. Whether it's distributions or a pension or Social Security, they might have gone $20 over. Now they're having to pay, $70, $80 extra a month for Medicare. So I think that's something that people often miss. And one thing too on that is IRMA looks back 2 years. So, if you're 67, it's based on what you were earning at 65. So it's a huge issue that a lot of people don't see until they get called up one day and they're like, hey, why am I paying this extra money? Another one, like we talked about, is QCDs, qualified charitable distributions. If you're giving money to the church, why not go ahead and get a benefit for that on top of obviously your charitable contributions? Most folks in retirement aren't itemizing. The majority of Americans are using the standard deduction. So, if you're going to give to charities, let's at least get a double benefit for it. So those are a couple things. Another one is in between. Maybe when you turn on Medicare and you're kind of in the thing between Medicare and when you have to start taking RMDs, you're kind of set on IRMA, maybe your limits. Does it make sense to do Roth conversions? So taking money from your traditional IRA and putting it into a Roth, so that way you have another tax lever, comes out tax-free to your kids. That's something huge, but one of the issues that we see is, you hear some guru on social media saying, oh, Roth conversions are the best thing ever, let's get in the 0% tax bracket, whatever. But you're having to pay taxes on that in the year you do it. So you got to have a strategy behind all of this. And I think that's the main thing, that if you take anything away from this, is it's all about planning and a strategy. All of these are great, but they have their place, and doing, any of them willy-nilly is not going to be in your favor.
Yeah, so what I'm hearing is, have a plan, right? Work with a financial professional that does more than just investments, right? It's taking a look of your total wealth and coming up with a strategy for taxes, coming up for a strategy for investments, coming up with a strategy for continuing to save if you're still working. So from what I'm hearing, it is hire a professional that is going to take a look at your total wealth and come up with a real game plan. Yeah,
no, you hit the nail on the head. And like you said, there's plenty of folks out there that, maybe they work with a big box shop and all they get is investment management. I mean, we see that all the time. They come in like, oh, I got a financial plan. My guy's a genius. And it's like, okay, well, you just missed this, this, and this. I'm looking at your plan and the plan's wrong. There's nothing about any of it. And it's just a plug-and-play system. And unfortunately, there's no one-size-fits-all financial plan, and I think we see that all too often. So, yeah, make sure you're working with somebody that's qualified, is looking at all of this. And if they're not asking simple questions like, hey, how was your tax situation last year? What are your goals? Can I see a tax return? I think that's a big red flag right there. So if that's something that maybe you're having issues with, give us a call.
So we have a signature question that we always ask, and that's what makes you tick.
So I've answered this a couple times. Obviously, God and my family makes me tick, on a personal level. But I think helping folks, there's nothing is a better feeling than having somebody come in and maybe on the tax side, for example, finding those little things that somebody missed, right? Such a great feeling. Reviewing a tax return and seeing, hey, I could save you, here's some strategies that could potentially save you tax dollars and put you in a better situation. That's such a great feeling, helping folks plan for retirement, make it through retirement, and be comfortable. I mean, that's just, seeing somebody smile on their face and knowing that they're sleeping better at night because they're working with us. I mean, you can't beat that feeling. So I think that's what makes me tick, both personally and professionally.
And I have to agree with that. Just seeing the sigh of relief when we're going through, our plans and their goals, and just the sign of relief of people. You could just see it on their face and their body language when we kind of go through things. They're just relieved and stress-free. I think that's really, besides my family and God, that really makes me tick.
Yeah, awesome. Yeah, well, this was fun. I know taxes are not everybody's favorite topic, but it's something that's important, and love talking about it. It's fun when you can come up with new strategies and obviously not have to pay unnecessary money in taxes.
Awesome. Well, thank you all for listening in and watching us. I'm Anthony Colancecco. This is Cameron. Thank you for watching another episode of Connected by Community, brought to you by Ballentine Capital Advisors. Go out and share us, like us on all social media platforms, and go out and make our community great.